All right, I'll just do a quick introduction and then we can start. Hi everyone, thank you for joining us this morning. I mean noon if we must. Before we begin, let's take a moment to reflect on the land that we're on and its history. We acknowledge that the land that we are meeting on today is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, and the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis peoples. We are most grateful and respectful for the use of this land. And a little bit about our speaker today, Mohsen Selseleh. I hope I pronounced that
Yeah,
correctly.
correct.
He holds an MA in mathematics from York University and an MA in data science from University of Guelph. He is currently teaching business analytics at George Brown College in Toronto, and with a strong foundation in quantitative methods and applied research. Mohsen specializes in financial risk modeling, credit scoring, and mixed methods analysis. And we look forward to your speech today. Mohsen, over to you whenever you're ready.
Thank you very much for all of you that come and would like to listen to me. Thank you for your precious time that you consider for me. I hope you learn some interesting material. My topic is about trade shocks and credit risk in the Canadian steel sector, import disruptions, tariffs, and financial distress between 2016 to 2020. First, I'm telling you why I chose this topic. I would like to know that how can we protect Canada's steel industry from sudden economic shocks? The steel sector is so vital to Canada's economy, but it faced two major disruptions in that period. 2018 U.S. tariffs, 25% tax on Canadian steel exports. We know that Canada exports 80% of its output to USA, and at 2020 COVID-19 pandemic. Both of them make disruptions on Canadian steel industry. When USA put tariff at 2018 on Canadian exports, results causes surplus steel diverted in Canada, domestic oversupply. And it caused that the prices down and the profits of the steel company in Canada decreased. Rising imports, therefore, we can say that it is an early warnings of signals of sector stress. What is the research problem? I would like to know that can we use a simple number like monthly steel imports as an early warning signals? For example, if imports fall today, can that predict financial stress months ahead? If yes, banks, Canadian banks and regulators could intervene early, protecting jobs and stability. I have done literature review, similar research that have done in this field. And I found that majority of the papers look at these things, some of them, all of them, some of them, as trade shocks, as tariff disruptions, financial stress, for example, rating, lending, default channels by the banks. Some of the paper used from ITS models to detect structural breaks from policy shocks. Some of them use machine learning algorithm to find warning accuracy. Some of them consider dynamical regulation that I will consider all of them in this paper. For example, MET and argue tariff sanctions or pandemic disrupt trade. He has written a paper about 2018 steel tariffs, and results show that real financial pressure on trade reliant business, because Canadian steel companies sold less, paid more for material, and lost access to key market. Bolton and show that when the real economy slows, credit risk rises. It means that lower trade and production, big companies to repay their loans. Therefore, the banks tight the lending laws. There is a word, loan covenant channel, means that the bank tight the rules to give loans to a steel company because the rating drop. When you go for apply for a loan, they check your credit. It's similar to the steel company. For example, when their rating drop, the bank hardly give them loan. Therefore, defaults and distress rise for the steel company. The Bolton showed this in their research. Some Bernal et al. At 2018, they used from the econometric models to test policy on this change. They use from interrupted time series, ITS, to check before and after an event. Because why they use from this method? Because they don't have no control group. Do you know when we are going to use from causal design, you need that control group to set that this variable effect on the group. But we don't have any control group to compare the results of the test and train with each other. Therefore, interrupted time series is very interesting method that we can use. Other research, Bolton showed that economic shocks spread through the finance. Lower profits causes to less borrowing or more defaults. Banks cut lending and recovery slows. Other research, Chodorov, show rating and sentiment amplified downturns. Monitoring these loops enable early risk detection. The methodology that I used in this method was ITS. I tried to analyze imports before and after 2018 tariff and March 2020 when the COVID surged. Other method that I used was machine learning algorithm to predict stress with AI, random forest, and XG boosting to predict 2020 stress events. Meanwhile, I used from test of causality. I used from Granger causality. In the simple word, Granger causality, do change in import happen before change in financial risk? If yes, imports can act as an early warning signal. It was my question. For example, a sudden jump in steel imports might mean trouble incoming for steel companies. Simple idea for this is similar to this when you are going to a picnic and first you go and check the weather. If you see that it's the problem of raining or a storm, you don't go for a picnic. Imports could be signal as this. Meanwhile, I use from STL decomposition. I try, it's similar, this method. If you don't know this method is, for example, you have a clock and you are going to take apart it to its gears. With this method, I split my data set to 3 parts. Trend, to see the big picture. I have going up or going down, decline or increase. Seasonality, to find the regular ups and downs for like holiday sales every December. And meanwhile, to find shocks and noise, sudden surprises as tariffs, pandemic. Why I use this method to spot what's really driving change, especially those hidden shocks that affect financial risk. The data set that I have was two data sets. I find this data set from Stat Canada. One of them was monthly steel imports into Canada. Other was annual steel exports from Canada, including to USA. And the time was between 2016 to 2020, and measure was import values in millions of Canadian. The key variables in my analysis was steel import value. Meanwhile, I make some kind of variables as tariff dummy, one after March 2018, zero before, March the tariff shock, MOM, month over month change, YOY, year over year change, and log imports, smooth big swings for better modeling. And my outcome, the first one was independent variable, and this one is dependent one. Financial stress. If imports drop more than 10%, I consider as stress. And probability default that show that risk a firm will fail, and expected loss that I calculate all of them, and I will show you in the result. First, I must tell you what has been probability default, because you see this word a lot in this paper. I did not calculate probability default from in all other research. They calculate from firm level financial data, because other company has a balance sheet or income statement. But because I consider the steel of Canada as a total, I did not have the balance sheet because each company has a balance sheet. But it was steel of Canada as a total. Therefore, I calculate probability default with my method. I consider its increase linearly over the time, and therefore, probability default in this paper is an input variable likely derived from an external source or constructed based on assumptions rather than being calculated internally from fundamentally firm data. It is a synthetic data set. It is generated with considered past experience. Expected loss, there is a formula, PD, LGD, EAD. But I did not use from this formula too. With consider to other research that they used from similar method, I consider expected loss as probability default multiple import value, a proxy for EAD. And LGD is omitted because some papers I consider it constant or absurd in a scale of import value. This is not a violation of theory, because I saw that other papers use these methods too, but because it was a pragmatic approximation, because through EAD, LGD are not variable. Descriptive analysis of this data set show that before 2080, we have a steady at 900 to 1,100,000,000 in months, and after tariff, dropped to 800 million and never bounced back. After COVID, it crashed to 600 million, lowest in 5 years. Therefore, each shock made an import drop, signals rising financial stress. You can see all of the different type of the imports of the steel in Canada decreased over the time from 2018 to 2020. And when you see that in the graph, the Canadian steel import, you can see here that two shocks to 2018, 2020. After 2018 tariff by USA, you can suddenly increase in the imports. And I explain this why it happened. When import value drops sharply after tariff or COVID, the model flags it with one orange dot. You can see an orange dot here and another orange dot here. the result of the tariff at 2018, see in this orange, and COVID in this orange one. They really show the, in my operation definition, some kind of important drop. You can see here that imports spiked right after 2018 tariff, peaked in June 2018, and steadily declined at through 2019 and never fully recovered. Why? Canadian steel couldn't reach US, flooded domestic market, imports surged temporarily, then price fell, firms hurt, demand dropped. It's my explanation. Maybe it's not 100 correct, but I think we saw that suddenly after tariff imports increased, but after that it decreased. I think it was as this. Tariffs don't just block trade, they distort it. Short-term float causes long-term pay for business. Other method that I use was STL decomposition, a method for decomposing time series. If you are not familiar with time series, with this method, you can break the time series into trend, seasonality, and noise. We broke into three parts: trend, long-term, seasonality, yearly ups and down, or monthly, holidays decreasing, and reminder random shocks. After 2018, trend turned downward permanently. Imports never bounced back to pre-tariff level. The tariff fundamentally altered the long-term trajectory of the market. STL decomposition trend decreased permanently after 2018. Imports never returned to old levels. Other method that I used was linear trend model with seasonality. It captures both long-term and short-term patterns. And up to now, I just work on the import data set. But look, it is about exports data set. And you can see that here, after 2018 is tariff, and you see that export decrease. We have see here a negative trend, average of 162 million per year over 2016-2020. We see some peaks post-tariff pandemic hit. Why? The tariffs and COVID disrupted trade flows. Exports never recovered, and it is similar to research of the MIT and Redding and Weinstein. Short-term sparks masked long-term decline. Shocks reshaped the export landscape. I use from machine learning models too. Accuracy of the random forest and XG both was 80%, but there was very interesting thing. Their recall was 0. They missed every warning. These smart models were good to predict in good times, but in the real shocks, they could not find it, predict it. Therefore, I think it's better that we use from simple economic tools. They actually catch crisis as ITS, trend plus seasonality. Therefore, I think if you would like to find the chaos in the real world, use the simpler method than machine learning, because they miss every warning. Other methods that I used here was a Granger causality test. Does A predict B? Does past steel import data help forecast future credit risk better than just using probability default on history? Results show that although it was weak, but it was meaningful. When import change, probability default tends to change afterward. What does it mean? It means that when import drops sharply, After tariff, financial stress often follows. A usual early warning, so not perfect. To think it as some put a canary in a coal mine for still films. Here you see that's the result of the impulse response function. Blue line represent impulse response itself, and dashed lines show that 95% confidence interval. Look to the blue line. Blue line show the probability default. For example, top left show that when monthly change decrease, probability default decrease. And the meaningful one, one of them has a significant p-value, was the bottom left, this one. Month over month change causes probability default. And you can see that probability default here. When months per over months increase, you can see the probability default decrease. I think I should just speak about the meaningful one because other one was not meaningful. Bottom left, month over month change shows how a shock to import change affects future credit risk. This directly answers my question. What happens if imports suddenly drop? A negative shock to imports causes probability default to rise. The blue line decrease below zero. And then the dashed lines show that probability default rising, peaking around months 1 or 2, and fading by 6 to 8 months. It is my key finding. Bottom left, show how import change affect credit risk over time. This is key finding. Other method that I have used here was expected loss. Here, blue line show that still imports. And you can see the dashed, it show that section 232. Section 232 was the tariff that US considered for Canada steel. And the green one show that COVID-19. It showed that expected loss. The orange one showed that expected loss. And you can see that expected loss increased in both 2018 and 2020. You look, blue line show that steel import decreased over the time, but expected loss increased over the time. Expected loss has a formula, probability default, LGD, EAD. After 2080, import and risk diverge. Low import no longer mean low risk. A structural break, shocks change the import-risk relationship. Watch import as an early alert. When they fall, brace for rising financial pain, even if it takes months to show. This helps banks and regulators act fast to avoid bigger problems. Imports down, risk up. Financial pain ahead. After tariff and COVID, steel imports fell, expected loss keep rising. This picture show us that imports predict stress. Financial troubles follow 6 months later. Exports falling. Canada steel sector is fragile to US policy and global demand. Shocks leaves scars. 2018 tariffs permanently cut imports level. And my machine learning algorithm models failed. They were great in calm times, are useless in driving crisis. But if you look at my ITS and Granger test, the simple econometrics models, they gave me clear signals. Therefore, I think watch training data closely is your best early radar for financial risk. And for the policy advice for regulators, watch monthly imports. They are a fast, early warning signs of trouble. Use simple tools, ITS Granger, clear, reliable, and crisis ready. And avoid over reliance on complex AI models. It fails when you need it most. Keep it simple, stay ahead, and act early. It's why I use different references. If you need, I can give you all the paper. It has more reference studies, but they are the most important papers that I use. Okay, I'm ready here to you ask question.
Thank you, Mohsen, for your presentation. Just
Thank you
anyone.
very much. All of you that you give me your precious time to me. Thank you for Professor Foreman, Professor Johnny, all of you that give me great opportunity. Really, it was so interesting for me to work on this topic, and it was very great opportunity to present my work. Thank you.
Yeah, well, does anyone have any questions? Well, I guess no one has any other questions
Thank
of
you.
speech. I will give everyone your LinkedIn maybe, Mohsen. So like if
Thank
they
you
have
very much.
in the
Thank you
future, they
very
can
much.
to you. And yeah, thank you, Mohsen, for your amazing presentation. And thank you everyone for joining today. And we look forward to seeing you again for the next colloquia.
Hope I could continue to presentation as it's so interesting was research for me too. And thank you for your precious time of all of you. And another time to this good institute. And thanks of all of the people that participate. And it was so interesting. I learned a lot of things myself too. Always I learn a lot of things from the RISC Institute. And hope the best for you. Thank you. Thank you very much for your time.
Thank you, everyone. Have a good rest of your day.